Welcome, Sam, to the wild and wacky world of portfolio management. Today, we're going to dive into the magical universe of Markowitz, efficient frontiers, and the all-important diversification effect.
Professor, could you remind me who this Markowitz guy is again?
Harry Markowitz, the man, the legend, the father of modern portfolio theory. Picture him in the 1950s, probably wearing a snazzy suit and glasses so thick they could double as magnifying glasses. He came up with the idea that, instead of putting all your eggs in one basket, you should spread them out. But not just any basket, optimally selected baskets.
Okay, spreading eggs. Got it.
Excellent. Now, let's talk about portfolio measures. Draws on whiteboard. Imagine your portfolio is a superhero. You want to know how powerful it is, right? So, we use measures like the expected return, which tells you the average superhero strength, and risk measures, like standard deviation, which tells you how much your superhero strength can vary. Because, let's face it, even superheroes have bad days.
So, if I understand correctly, the higher the standard deviation, the more my superhero strength can fluctuate.
Exactly. Now, let's dive into diversification. Picture this. You're at a buffet. If you only eat chocolate cake, you might get sick. But if you sample a variety of dishes, you get a balanced diet. Diversification in investing is like having that buffet. Different investments help reduce risk.
So, I should mix up my investments like I mix up my food choices?
Precisely. Let's see all these concepts more deeply. Okay. Recall from the lecture on return and risk how these measures are computed. Historical return, expected return, and risk for a given stock. Let's define the weight as the proportion of money we invest in a stock. It is expressed in percentage. Let's see how the portfolio return is computed now. We take the simple case of two assets A and B. The portfolio return is defined as the weighted average of the asset returns. We can do the same thing by defining portfolio risk as the weighted average of asset risks. However, if we do that, we do not see the diversification effect. We just combine things, and we did not take into consideration the relationship that can exist between the two assets. Okay, let's see what kind of interactions that can exist between assets. We can have assets that move in opposite directions. The first increases while the second decreases. In this case, we have a negative correlation, or they can move in the same direction, then we have a positive correlation. Now, redefine the portfolio risk by adding to the weighted average of asset returns the interaction measure between them. Now the diversification effect is straightforward. So, if the two assets move in opposite directions, then the correlation is negative, and its negative factor also reduces the weighted average of the asset risks. Otherwise, the portfolio risk will increase beyond the weighted average of the asset risks. But don't worry, when we do diversify and invest in more than 8 or 9 assets, the portfolio risk is systemically decreases.
Got it. Very simple.
Now, let's move on to the efficient frontier. Think of it as the coolest club in town. It's where the best portfolios hang out, those that offer the highest return for a given level of risk. And who doesn't want to be in the coolest club?
So, the efficient frontier is where all the cool portfolios are?
Yes, indeed. Let's see this more closely. Let's visualize in two-dimensional space the best portfolios in terms of return and risk. Imagine we would like to invest in this portfolio. The question to ask then is there any other portfolio having the same return but with lower risk or a higher return with the same risk? Otherwise, our portfolio is not optimal. Imagine now that we would like to do the same thing and find all optimal portfolios in one or the other direction, return or risk. All the optimal portfolios lay on a concave curve that we call the efficient frontier. It contains all optimal portfolios with risky assets.
I got it. So simple.
Exactly. And speaking of cool portfolios, let's talk about the global minimum variance portfolio. This one is like the pacifist superhero. It's all about minimizing risk. It's the safest bet, but it might not have the most thrilling superpowers.
Got it. What about the maximum Sharpe ratio?
The maximum Sharpe ratio. This is the portfolio with the best bang for your buck. It's like finding the perfect balance between risk and reward. It's the superhero that gets the job done while also looking fabulous.
So, to sum up, Markowitz taught us diversification is key, the efficient frontier is the cool club, the global minimum variance is the safest, and the maximum Sharpe ratio is the best value superhero.
Exactly. And remember, in the world of finance, there are always new adventures. Keep your portfolio diversified, aim for the efficient frontier, and never forget, risk is like a superpower you need to manage carefully.
Thanks, Professor. I think I'm starting to get the hang of this.
Wonderful. Now go forth and conquer the world of portfolio management. And remember, always balance your investments like you balance your diet. See you next time, and goodbye.